Let's connect with Shyam Sekhar. Well, this is a long debate as to why Indians have historically not preferred equity as an asset class, and why our real estate numbers and our gold numbers are simply out of whack. And we've been talking about this again and again. The example which I like to quote here, which is from Warren Buffett, that you pick up all the gold in the world, and you will end up with a cube of 80 by 80. By 80, it's like a cube, which are 3 dimensions. And in that you can buy, that would be worth $7 trillion, in which you can buy all the farmland in US, a company of the size of Exxon Mobil, and then you would still be left with about $3 trillion of wealth. So if you buy gold, you're always buying something which is a hedge against inflation. It is never ever buying something which is non-productive. The gold what Indians have is lying in the locker, and you can look at the gold, feel happy that you've got gold in your house, but trust me, you are investing in something which is absolutely non-productive. Shyam Sekhar, good morning. The smile on your face tells me that you agree with my assessment. Are you telling your wife, and are you not buying gold for your daughter? Can I assume that with your smile?
I have never bought gold.
You never bought gold?
My total purchase of
How
gold
did
in
your
my
wife
life
react
is
to
1
that?
1 lakh.
How did your wife react to that? Before all the Tamilian festivals, if you don't buy gold, I mean, were you able to maintain a peaceful environment in the house?
It's quite peaceful. My total allocation to gold in my portfolio out of my earnings is 1 lakh, not more than that.
Okay. Shyam, so do you think the financial inclusion data which we were discussing, that Indians currently are completely under penetrated in their financial commitment to assets, which is equity, bond, or for that matter fixed income, it's only going to churn and improve?
Hey, it will definitely improve, but there is a long way to go. See, in the sense, I feel that the financial services industry is still not viewing the opportunity from a longer term trend. I think that it is chasing too much of near term goals, and these things come to hurt in every cycle. And this cycle also, though the kind of excesses are definitely lower than the previous cycle, I think there is a tendency to lean towards excesses for short term gratification. And the industry, the financial services industry, is guilty of that.
And so what's the solution to that issue? I mean, how do you see the pickup in loan activity happening? I'm given to understand that part of the reason why NBFCs are doing so well is because retail lending is really seeing momentum, and the money is being reallocated. So banks are now pushing more towards building their retail book versus their corporate book, because corporates don't see the need to expand or take debt.
I think the banks looking towards increasing retail book is more out of necessity than out of any invention or innovation. I think that they are having a huge crisis in finding good lenders among the corporates, and that is what is pushing them towards retail. Another thing is that today I think the retail lending is a borrower's market, and I think any borrower's market is not going to be a happy thing for lenders going forward. There could be something in the future that would definitely affect the lenders, because the lenders are going to compromise on something or the other to sustain their growth, and that is happening in retail today.
Shyam, let's talk about your view on earnings and IT. That's going to be the most curious case, even though Infy will come out with its numbers only post-market hours. Would you say that the worst perhaps is over for the sector? You've talked about it being a safe haven investment play, that one must be, playing all the buybacks as well. Why do you believe that IT is a pocket where one can make money?
See, actually, there are not too many avenues today to invest. If you see the kind of ideas that people are throwing around, mostly these are in the nature of trades. And we are trying to turn trades into investment by trying to project that their earnings look visible and sustainable for a couple of quarters or maybe little more. So in that sense, we are trying to make choices which may not sustain in the long run. Let me give you an example. Once the higher cost inventory of petro products and oil comes into effect in the third quarter and in the fourth, you will find that the earnings projections of a number of companies which are into rather basic chemicals and plastics and B2B predominantly in B2B. All these earning premises are going to be tested very badly in the coming 2 quarters. But this quarter's earnings may not show anything. On the contrary, if you take IT, it is also not reflecting what will be the future impact of the exchange rate on the industry. And another untold story about IT, which nobody is reporting because it is expedient not to report, is that there is a sustained cost cutting that is happening in these companies. These companies have a history of being good allocators of capital. And in a market where you don't have ideas, I think one should play on better allocators of capital because they could come up with some special situations. A classic example is the Infosys buyback.
Let's talk about your other contra bet. I won't say contra, but it's a bet that you believe the strength in steel is here to stay. Now, historically, it's very dangerous to call the top and the bottom of a commodity cycle, and steel is a commodity which is completely and totally dependent on what not Indians do, but what Chinese think. So what makes you bullish on steel?
See, I think we have to call the end of globalized trade in several commodities. I think markets will turn insular, and governments have a need to turn the markets into insular markets, at least to protect their banking system. India has put out a document which is a 2017 steel policy which talks about 300 million tons of domestic steel. If that is a priority, then you should make the market reasonably stable and insular to global trade. So I think that this trend is going to gradually gain momentum. I'm not making a recommendation to buy a steel stock today or tomorrow, but I would tend to believe that the government's sincerity in actually turning the steel market into a more stable and insular market with domestic production increasingly contributing to domestic demand will be something worth looking at. I believe that steel is a sector where there is definite growth, and this growth, if fed by domestic demand, you are going to see operating leverage. Another important aspect in steel is that we see an imminent consolidation. I would doubt if any of these promoters of the defaulting companies will be able to hold on to these companies. And you could see a situation where steel consolidation will happen very quickly through the NCLT and the IBC. In that situation, we could see competitive dynamics change very fast. You will remember the recent consolidation, and it is almost at a very advanced stage in telecom, where consolidation has happened very fast. Few players have taken a huge hit and walked away. That leaves the players who are standing in a very good wicket. And I expect a similar scenario in steel, but it's not going to be imminent. It's going to be after a few months or even a few quarters.
A very interesting observation there, Shyam, when you talk about the fact that most people have missed out on the telecom consolidation. They may have missed out on, the news trigger, but do you think the time has completely run out to buy into telecom stocks? Every day they're going up 8 to 9%.
See, I think that you cannot buy a stock after it's gone up 30%. That's not my way of investing. So it's very difficult for me to buy a stock after it has gone up 30%. On the contrary, it's very easy to buy a stock when it has gone down 30% and has all the bad news in the price. I think it's quite tough in these kind of situations to estimate how much of the good news is in the price. And you only have one or two more entities left to consolidate, and then again earnings should take over. You will agree that telecom earnings are not anything earth-shaking at the moment. So I think that trade has largely played out.
Shyam, we have 5 Nifty companies coming out with their numbers, which represent 5 different key sectors, all day long today of the economy, of course. You have Infi, you have HDFC Bank, you have Asian Paints, you have Ambuja Cement, and you have Z Entertainment. Give us your sense on, where would you see the bias top down in either of these sectors? What would you take from the earnings of either of these stocks to take a call on making perhaps a fresh investment in the respective sectors?
So I think that you're not going to have any positive surprises which are going to really shake up the market. So what market should be looking is for forward-looking statements. In the case of Asian Paints, it's a fantastic company, but I think it has the wind on its face. So I don't think that it can really give a forward-looking prognosis that is too optimistic. On the other hand, the company also has an opportunity in that the smaller micro industries, which have been a very significant part of the paint market, are facing huge challenges post GST. If the company can grab market share from these players, I think that then it could be an interesting situation. On HDFC Bank, I think that it's over-researched, and I think expectations are mostly barely met. I don't know if they will be exceeded by any wide margin. In the case of Infosys, I think it's more a case of what kind of messaging they're going to do. I don't track Z, so I won't be able to make a comment on that. And cement, again, all the good news is in the price. And most cement companies are trading at reasonable valuation. So I don't know how market can be positively surprised. So in that sense, Nifty results are going to be somewhat pedestrian and boring.
That is the case. Why are you of the view that one should avoid funds which excessively own mid caps? If Nifty numbers are going to be pedestrian, mid cap is where the growth should be. And if mid cap is where the growth should be, your house advisors avoid funds which have exposure or large exposure to mid caps. Am I getting it right?
I don't, I'm not advising any funds in mid cap at this point for the simple reason that most of the mid cap NAVs have a significant impact factor. See, because of capital flows getting deployed, there is a huge impact component of NAV in mid-cap funds, right? And I think that if there is even a small bad news on the global front or anything, I think this reverse impact will come. You saw it during demonetization how mid-cap funds lost NAV. I believe that in any potential future situation, the impact would be much worse. That's my fear. And I think that a lot of mid-cap funds have converted trades into investment. Like the commodity trade, there are a lot of investment sitting on the soft oil prices and petrol prices. So I think all these trades will be tested severely. And financials are again another area where over ownership is never a good thing, and history has taught us that several times. Yet, I think the mid-cap funds have not learned their lessons.
All right, Shyam, we'll leave it at that. Thanks very much for taking out the time. Always a great pleasure speaking with you and learning a bit more about the principle of contrarian investing. Thanks very much once again for your insights.